We believe investors should have exposure to biotech over healthcare more broadly because biotech represents the most innovative subsector in healthcare, where we believe the most substantial value creation is occurring. Investors in biotech get exposure to the latest cutting-edge technologies in healthcare, including gene therapy, cellular therapy, and RNA modification, which are leading to breakthrough therapies for diseases and transforming patient care. We think the Biotech Growth Trust is the best vehicle to gain exposure to biotech because OrbiMed Advisors is one of the largest and most experienced investment firms solely dedicated to investing in healthcare. We have a truly global footprint with headquarters in New York and offices in San Francisco, Shanghai, Hong Kong, Mumbai, and Israel. Our staff includes professionals with a combination of both business as well as scientific and medical expertise. That scientific expertise is critical in evaluating new drugs being developed by biotech companies. Finally, we have been investing in biotech for over 20 years, so we have a lot of experience investing successfully in this particular sector. We have traditionally had a fairly balanced weighting between large-cap biotech and small-cap biotech. The large-cap biotechs, which consist of the more mature, profitable companies, are trading at historically low valuations right now. We feel there is a lot of potential for these names to re-rate, whether it's via M&A, pipeline developments, or new product launches. We also have a number of smaller positions in emerging biotech companies, which can be more volatile because they are not profitable yet and are highly dependent on the prospects of a single lead product. The portfolio is well diversified by market cap, and we size our positions based on the risk of each security and our conviction level in each idea. Having said that, with the recent acquisition of large-cap portfolio company Celgene by Bristol Myers Squibb, we do expect a natural shift in allocation to smaller biotech companies as the Celgene transaction proceeds are invested in smaller names. Ultimately, the balance between large and small-cap biotech will be based on our assessment of the prospects of each individual name. 2018 was a tough year for the Biotech Growth Trust and biotech generally. Large-cap biotech saw valuations contract as investor concerns grew over future competition to many of these companies' lead products. We believe the challenges facing these companies are well discounted in current share prices, and very little credit is being assigned to the companies' pipelines. Many of the newly commercial emerging biotech names launching their first products also saw their share prices decline, as peak sales expectations for their products decreased. Two oncology companies launching their first products, Clovis Oncology and Puma Biotech, were notable detractors to fund performance during the year. Traditionally, young revenue stage biotechs like these ultimately get acquired by larger companies, but M&A activity for commercial assets was relatively subdued in 2018. The fourth quarter of 2018 was especially challenging for the biotech sector, as macro concerns over international trade tensions and uncertainty about a U.S. government shutdown led to a precipitous fall in the markets generally. Biotech, as a high beta sector, fell in tandem with the markets. Despite the challenging performance in 2018, we think the fundamentals of the biotech sector remain strong, and we would note that there has been a sharp rebound in sector performance so far in 2019. One other factor that has dampened performance of biotech recently is the prospect of drug pricing reform in the United States. Over the course of 2018, the Trump administration announced a number of proposals to moderate drug price inflation in the U.S., including lowering out-of-pocket costs for patients, indexing Medicare drug prices to international drug prices, and eliminating the rebate system that obscures true drug costs to end users. We continue to believe nothing dramatic will occur with regards to drug pricing legislation, as we now have a split Congress, with the Republicans controlling the Senate and the Democrats controlling the House. We expect the split Congress to continue even after the 2020 elections, making transformative legislation very unlikely. Having said that, political rhetoric regarding healthcare reform could still create some headline noise for the sector as the elections approach. Ultimately, we think these overhangs will lift once investors realize nothing substantial is going to happen, and the biotech sector should rebound nicely, just as it's done in the past. The FDA regulatory environment remains very favorable for the approval of new drugs. Under former FDA Commissioner Scott Gottlieb, the agency has been very proactive about expediting the approvals of innovative drugs by being more flexible on the clinical trial requirements necessary for approval. These initiatives have helped to reduce the time, cost, and approval risk for new drugs in development, which has benefited the biotechnology industry. In fact, in 2018, the FDA approved 59 new molecular entity drugs, the highest number of new drug approvals in history. In March, Gottlieb announced his resignation, but the new commissioner, Ned Sharpless, has publicly stated he intends to continue Gottlieb's policies. We therefore expect the regulatory environment to remain constructive for the biopharmaceutical industry. We are in a golden era of innovation in biotech right now. there are a number of novel technologies, including gene therapy, cellular therapy, and RNA interference, that are yielding new drugs having transformative benefits for patients. Products based on these technologies have already reached the market, and many more have shown positive data in human clinical trials. We believe we are in the early stages of these technologies reaching their full potential, and that ultimately, many of these technologies will yield product categories in excess of $10 billion of peak sales potential. M&A activity remains a key driver of investment performance for the biotech sector. While there was a bit of a lull in M&A in the second half of 2018, we have already seen a pickup in activity in early 2019. Some announced transactions include the $74 billion acquisition of Celgene by Bristol Myers Squibb, the $5 billion acquisition of gene therapy company Spark Therapeutics by Roche, and the $800 million acquisition of gene therapy company Nightstar by Biogen. Celgene and Spark Therapeutics were positions in the portfolio when those transactions were announced, and there are many more companies in the fund that we think would make attractive acquisition targets. Many of the larger biotechs are facing growing competition for their more mature products, so we think the urgency for them to acquire smaller companies has only increased. And as we've seen with Celgene, the large-cap biotechs are trading at such depressed valuations that they themselves are also vulnerable to being taken out. While most of the biotechnology innovation historically has occurred in the US and Europe, we are seeing a trend towards increased innovation in China, the second largest pharmaceutical market in the world. The Chinese domestic drug market has been traditionally focused on specialty generics and traditional Chinese medicines, but the Chinese government has taken a number of steps over recent years to encourage greater innovation in drug development. For example, the Chinese FDA has tightened its approval standards to eliminate substandard products and accelerated the clinical trial process for innovative drugs. In addition, the Hong Kong Stock Exchange has recently relaxed its listing requirements so that pre-revenue companies can now go public, opening up a key source of financing for the Chinese biotech sector. As a result, the fund has actually participated in two recent Chinese biotech IPOs, one in oncology and one in the vaccine space, and both have generated positive returns thus far. Because OrbiMed has offices in Hong Kong and Shanghai, with dedicated public equity analysts in those locations, we believe we are well positioned to capitalize on this emerging opportunity. We believe the outlook for the biotech sector is very positive. Innovation remains strong in the sector, with new treatment modalities like gene therapy potentially transforming patient care and treating previously incurable diseases. The regulatory environment remains supportive of new drug approvals, and clinical trial requirements have become more flexible. Large-cap biotech companies continue to trade at a valuation discount versus historical norms, and we are seeing some signs that M&A is picking up in the space. Political rhetoric on drug pricing may persist into the 2020 elections, but we ultimately do not expect any substantial impact on the biotechnology industry given a split Congress. Finally, we see increasing opportunities to capture innovation in emerging markets like China. Despite the difficult performance in 2018, we are not planning any dramatic shifts in portfolio strategy, as we believe the portfolio is well positioned to outperform in the long run. While our holdings will remain well diversified between large and small cap biotech, we would expect large cap exposure to naturally drift downwards as the proceeds from the Celgene acquisition are redeployed into smaller names. We believe the portfolio is well positioned to capture the value creation from the exciting developments in the biotech sector today.